around the world. And so you kind of saw a structural shift in terms of the perception of the dollar. And even though this dollar is still strong relative to other currencies, there's just been less overall global appetite to really focus on it. And so I think that global financial crisis was kind of the culmination that waked a lot of people up to see how bad the issue is.
Hey guys, welcome to Everyday Finance. According to macro strategist Lyn Alden, the market is in a dark, directionless phase that could last years. The current cycle is fractured and unpredictable, so the old playbook no longer applies. The US imposing 100% tariffs on China seemed extreme in late 2024, but it's now reality, causing global markets to face new risks. Stocks rose when money flowed and fell when it dried up for the past 2 years. Signals were still readable by analysts. In today's headline-driven world, markets swing violently on news, forecasts change within days, and no strategy lasts. Staying afloat requires constant adjustment and scenario modeling in this reactive environment. Alden expects a structural shift despite volatility. If liquidity remains somewhat stable and corporate profit margins continue to deteriorate, traditional equities, long the backbone of investment portfolios, may unravel. Bitcoin and other non-company assets could shine in that case. Bitcoin relies on disruption, scarcity, and changing monetary expectations, unlike stocks. Bitcoin has replaced some equity exposure in Alden's portfolio strategy to hedge against inflation and institutional breakdown. As intended, it's holding value, outperforming traditional stocks in choppy conditions, and gaining ground while legacy systems wobble. Alden stresses that understanding the underlying forces, not just reacting to the noise, is the key to navigating this market as it evolves. Let's watch the video ahead.
So I think the global financial crisis was a big changing point, but we can go back to the history of how we got there. So, basically every friction in money for several centuries was solved by a layer of centralization. So for example, if we want to transact, we can get out our coins and banknotes and transact, but it's far easier, especially at scale, if we both have the same banking partner and I can just say transfer value to him and I get the product you're selling me. That's an easier way to do it. And then if we want to transact with someone else using a different bank, we want our bank to be able to transfer value to them. And instead of having to do a transfer every time, it's easier for them to trust like a deeper bank that connects them. And so every kind of inefficiency was solved with another layer of centralization. And so that eventually culminated in central banking. And then even multiple central banks will group together on basically the world reserve currency central bank. And so you have kind of roughly 4 layers of centralization. And so in that current era, that's kind of how we got to this point. And I think that in the more, let's say, in our lifetimes or kind of near our lifetimes, you go off the gold standard in 1971, then there's this period of chaos for the 70s, and they kind of reestablished some degree of control. They kind of established demand for their foreign currency. They raised interest rates to really positive levels. But then they kind of start this ticking clock where you've established this system, but now it's kind of debt slowly accumulating. And resources slowly being drawn down to maintain it over a 40-year period. And every time there's like a potential bust, they come in with more liquidity. So in 1987, there's a big crash, stock market crash. Greenspan, the central bank head, comes in and says, no, he's calling banks and saying, don't worry, liquidity is available if you need it, kind of reinflate everything up. Then you kind of go to the late 1990s during the dot-com bubble. You had the blow-up of long-term capital management, a huge fund at the time, very leveraged. They got messed up because of the whole kind of currency differentials around the world. The Fed organized multiple banks to bail them out. And then that kind of provided liquidity to the market to allow the dot-com bubble to kind of reach its insane level. And then when that collapsed, they kind of cut interest rates all the way down to 1%. Even though it was a fairly mild recession by most standards, even though there's a big equity crash, if you look at unemployment, if you look at GDP contraction, that 2001 recession was pretty small, but they still cut interest rates all the way to 1% to try to reinflate things, and then they caused the housing bubble. And when that blew up, there was really nowhere else to put it other than at the sovereign level. So it's like every bubble, you kind of push it up to a higher level. You push a stock market bubble up to a real estate bubble. You push a real estate bubble and a banking bubble up to the sovereign level. So the federal government came in and they kind of bailed out some of the banks, not the homeowners, but the banks. And they put a lot of this onto the public level. And that caused a lot of anger. You saw Occupy Wall Street on one side, you saw the Tea Party on the other side, so you had people from the right and the left both kind of frustrated at what's happening and having different approaches to exactly what the problem is. But it's two sides of the same coin. And I think also at the same time, you saw a lot of other countries in the world kind of start shifting their trust ever since the global financial crisis. So going into that, there were multiple decades where central banks in aggregate were reducing their gold reserves in terms of tonnage. And in 2009, they did a hard pivot and started gradually reaccumulating gold tonnage around the world. And so you kind of saw a structural shift in terms of the perception of the dollar. And even though this dollar is still strong, relative to other currencies, there's just been less overall global appetite to really focus on it. And so I think that global financial crisis was kind of the culmination that waked a lot of people up to see how bad the issue is.
Lyn Alden sees the market as unstable and directionless, a choppy, uncertain stretch where buy and hold investing may fail. She believes passive strategies underperform, while active strategies like selling options can generate steady income, especially when asset prices are range-bound and lack momentum. Gold and Bitcoin's relative strength is attracting attention amid this turmoil. Bitcoin has held steady, while the market, including the Nasdaq, has fallen. Notably, it hasn't fallen more than tech stocks, a change from its usual behavior. Bitcoin used to fall harder during tech sell-offs, but now it's decoupling. Bitcoin is now seen as more than a speculative tech proxy or hyped asset. As shown by this changing behavior, it's becoming a global macro asset, affected by structural economic forces like monetary policy, global capital movement, and long-term systemic trends rather than short-term investor sentiment. This shift is important to Lyn Alden's portfolio construction. She now uses gold as a hedge against volatility and has replaced some of her stock exposure with Bitcoin, reflecting her belief that the financial world is changing. She views decentralized, scarce assets like Bitcoin and gold as alternatives and possibly the best long-term stores of value in an era of high debt, geopolitical fragmentation, and erratic fiscal and monetary policy. She believes we are entering a new financial paradigm in which resilience comes from adapting to a future where scarcity and decentralization define stability. Now let's get back to the interview.
I think one thing we see in history is sometimes you go through a period where in order to solve a problem, it gets worse for a period of time until you have another technology that makes it better. So a classic example is when people transitioned from Paleolithic to Neolithic period, like tens of thousands of years ago, they kind of shifted towards agriculture. For a little while, they actually ironically had lower life expectancies and higher rates of disease and tooth decay and things like that because they were getting out of their original environment and then they're kind of getting into this more clustered environment where disease can spread and where wars are more likely to be fought and things like that. Even though they had more power, they could go and displace the hunter-gatherers, and yet they themselves on a per capita basis were often worse off than they were before. It's like some of their own comforts also caused their own problems. And then it took a long time until they developed things like antibiotics or basic medicines, clean water like water pumps and good hygiene. Some of those things alleviated some of those early problems with civilization, but there's a pretty big gap during that time period. And then life expectancy started to go up to higher than they were in the Paleolithic period, but there's kind of that local low where you had these really big trade-offs. I think that's a good analogy for what we went through in money, which was, obviously the dawn of the telecommunication age is a good thing, but it did bring certain problems. Like our money was not fast enough to keep up, so we had to kind of invent this like fake money on top of it, and people kind of gravitated towards it. It really gave power to the bankers and the central bankers and the governments when that power was not really there before. So it came with pretty significant downsides. Our money got worse in order to facilitate this kind of new era we lived in. But I think that the invention of Bitcoin is kind of like the invention of basic medicines and water pumping and things like that. They can alleviate some of those issues with that era. So the telecommunication era has been this, when you exist in that gap where you have fast transactions but not yet fast settlements. So bandwidth was not good enough, encryption was not good enough, all these things were not sophisticated enough. But now that we have those sophistications, we can start alleviating the problems we built up over the past century and a half about these centralized ledgers. So yeah, there has been from the beginning significant downsides, and over time, as the systems get less and less stable, those downsides show themselves more and more frequently at a faster pace and at bigger magnitudes, and people are waking up. People obviously wake up whenever something acute happens. So for example, literally you can't access your own money. That's when it kind of wakes people up. Those subtle things go undetected for a longer period of time. So back before we started being so reliant on banking and central banking, debasement was still a thing. It was just a very slow process. So if a Roman emperor wanted to debase coinage to go to war, for example, he literally had to get the coins back from the people through taxes, remelt the coins, and then spend them back into the economy and kind of capture that opaque spread that he just made between taxes and spending is through that kind of debasement. Less precious metal per coin, and there's only so fast you can do that. You can't just teleport everyone's gold and silver coins to you. It actually is that forceful process of gathering them, remelting them, and distributing. That's why you see debasement was usually pretty slow. It's a pretty slow process. It would happen over generations. But once we went to the post-telegraph era, where everybody just kind of keeps their money in accounts. And even often the bank's not holding the gold, often the central bank is holding the gold, and the banks are just a ledger on top of the central bank. With one stroke of a pen overnight, they can cut a currency in half. They can cut it by 3/4. They can cut it by more. Over a 5-year period, they could cut 99.9% of the value away just by printing more and more money. Because the debasement's no longer physical. It's that abstract layer. And so that has really accelerated the power. And it spreads like a virus. So if one country is able to kind of devalue the liquid savings of its whole citizenry to go to war, the one that's being warred upon has to kind of do a similar thing. And so if one country can do it, it kind of spreads to almost all of them. And so I think when that problem's fixed, it's not necessarily an end to war. It's just an end to those subsets of wars that happen for that reason. An example, during the beginning of the Iraq War, right? So the United States was hit by 9/11. We responded to going into Afghanistan. But in that chaos, then the administration wanted to go in a separate country that was not involved in the 9/11 attacks, that's not even bordering Afghanistan. And and if you look at the public polls at the time, 70% of Americans, over 70%, were in favor of invading Iraq. Now, if you had to ask at the same time, okay, there's a 10% war tax on your income to pay for the war in Iraq, should we invade it? You can imagine that approval number would be way less. There's no cost, as far as they were concerned, there's no cost. They're like, well, we got this giant military and they're saying they're the bad guys, so let's go invade them. And there's no cost. The cost is instead opaquely deferred. So, in taxing and spending, taxing obviously can be coercive, but at least it's transparent, right? If they raise your taxes for a reason, that gives people can protest over it. They can revolt. They can vote for someone else. Or if it's not a democracy, they can protest and cause problems at scale. And that's why kings often would resort to debasement. It's basically the opaque way to take a little bit more off the top that's not really clear to people. And in the fiat currency world, that slice they can take off the top is much, much bigger. And so, the estimate so far for what the whole war on terror costs is something like $6 trillion. It's expected, with interest, it's going to go to something like 13 trillion. And if you would ask people at the time, this is going to, your future savings, your future wages are going to get heavily debased because of this war we're doing. Maybe people would have been less willing to do it. But that's basically a war that could only take place at the scale, especially at the scale that it did, in that kind of fiat world where you can just defer things so much and have the consequences delayed so much from the action that no one even blames them for the action. So for example, right now in the US and many parts of the world, we're talking about our fiscal problems, right? So we're running very large fiscal deficits in the US. And everyone's saying, is it Trump's fault? Is it Biden's fault? And all that. But no one's sitting there saying, is it George Bush's fault? Is it all the Congress and senators that voted at the time to go into Iraq war? Because that was certainly a big contributor to why we have so much debt and so much interest expense to begin with. What about the people that constructed the entitlement systems in a way that became unsustainable as the country aged, right? But that they're not in the discussions because the consequences are so far removed from a lot of the people that kind of initiated the core things, and we just focus. Everyone just has like a 4-year time frame or an 8-year time frame. They don't really think back 20 years, 30 years, 40 years, and that's the power of fiat. That it's opaque and it works for a reason. And so one of the ways you can protect yourself from it is you kind of refusing to hold large amounts of those debasing currency. Don't hold your value in something that other people can arbitrarily and opaquely increase the supply of.
Mm-hmm. The fact that people in Argentina still prefer stablecoins to conventional US dollars, despite the government removing 6 years of strict currency controls, is evidence that digital finance is changing how people deal with unstable economies. Many locals have discovered stablecoins like USDT and USDC to be more practical, affordable, and discreet than physical dollars, which some had anticipated would regain their dominance. According to cryptocurrency tax consultant Marco Zoccaro, using stablecoins to send money overseas is quicker and far less expensive than using traditional banking systems, which are frequently cumbersome and expensive. Privacy is another important consideration, according to fintech lawyer Ivan B. In a nation where financial surveillance is still a real worry, many Argentinians would rather transfer money covertly to avoid being noticed by tax authorities. Due to Argentina's banking system's continued lack of connectivity to international financial platforms, stablecoins have emerged as the go-to entry point for residents wishing to access global markets, particularly foreign cryptocurrency exchanges. This pattern is a clear reflection of what Lyn Alden has long highlighted. People naturally look for tools that give them greater control, flexibility, and security when centralized systems become too inflexible, unreliable, or inefficient. The stablecoin is that tool for a lot of Argentinians. For others around the world, it's Bitcoin, particularly in light of growing debt, currency volatility, and institutional mistrust. Both signify a larger movement away from antiquated financial systems and toward decentralized options that can flourish in unpredictable environments. Thanks for watching.